I think at the moment it's really important to be cognizant of what's going on in the macro landscape, and it's interesting at the start of every year we as a team get together and sort of think what holds for the year ahead. And this year has been, every year we say is going to be different, but this year I think is materially different to previous years. So why is that? Well, I think this is the first year in 10 where you're going to see rates start to move up, and that's pretty significant. And what we don't know is what the velocity of that those rate increases is going to be. We also are starting to see inflation. So just to give you an idea, all the earnings calls that we're listening to and the transcripts we're reading, those companies are really screaming inflationary pressure. So that's pretty interesting for us, and that's not something that existed 12 months ago. Above and beyond that, you look at the labour market. So the unemployment rate is near historical lows, and the labour market is extremely tight in the US, and that is potentially an inhibitor to growth. So you may own a company that manufactures doors, but you need the labour force to be able to put those doors in. Otherwise, you're just not going to sell as many doors, even if the demand is there. And then wage rates. So yes, there's been tax cuts, and that's very stimulatory, but in terms of wages, a lot of companies have increased their minimum wages. So if you go from $9 to $11, that's a north of 20% increase, and that's material. All these variables were not there 12 months ago. So you can't just say this year is going to be similar to last year. Last year we had a very benign year. We had 12 up months. I think this year is going to be vastly different. And I think when you're looking at your portfolio and any investments that you have and any investments that we're going to make, those variables need to be taken into account. So if you've got inflation, companies with pricing power are going to be okay, but those that don't have pricing power are going to have a problem. Now again, that didn't exist 12 months ago, so you could get bifurcation there. Those companies that have huge, significant labour costs as part of their COGS, and you've had wage increases, again, if you can't pass those through, that's going to be an issue. Those companies that have relied on cheap capital for the last 10 years, that may not be as easy to come by. So if you think about that, the ROIs for those companies or the access to cheap capital changes. So again, you get bifurcation for companies that don't need to access cheap capital and those that do. So there are a lot of variables going on in the background at a macro level that really are going to impact the sort of companies that you want to own in the current period and going forward. So what we want to focus on is companies that have tailwinds no matter what the economic environment is. So our largest holding, which we've mentioned many times, is a company called Entertainment One. That's a leader in content. So the demand for content, the appetite for content is voracious. So there's a huge tailwind there that's not going to be impacted by inflation or cost of capital or wages. If you look at Zayo, which is another company that we own that owns owns the only remaining independent fibre network in the US, the demand for data traffic is going to keep increasing irrespective of the economic environment. There are major drivers there, 5G being the biggest, which are going to ensure those tailwinds stay, and the demand for fibre capacity as data traffic keeps increasing, that demand for fibre capacity will keep increasing. So again, you can see the need for, we want to own companies that have very material tailwinds.